Most of us were taught a simple rule for investing. Buy a broad index fund, maybe mix in a standard 60-40 split of stocks and bonds, and let time do the work. The assumption is that these passive vehicles are inherently safe, naturally drifting upward over decades. For the last 40 years, that passive strategy worked. Interest rates steadily declined, and money flowed easily into U.S. financial assets. That environment created a system optimized for a straight, predictable upward line, giving the average investor a deep sense of security. But that straight line is beginning to crack. When you buy a modern, broad market index fund, you are told you are buying a tiny slice of hundreds of different companies to spread out your risk. That is the diversification illusion. In reality, the allocation mechanism of the stock market has quietly become incredibly top-heavy. This chart shows exactly what sits inside those index funds today. Instead of a balanced distribution across the economy, these funds have morphed into massive, concentrated bets, heavily reliant on just the top 10 artificial intelligence and technology companies. If you think you own a diversified safety net, you actually own a fragile, highly concentrated bet on a single sector, and that single sector is entirely dependent on physical infrastructure. The software and AI models driving those top tech companies cannot exist without extremely complex hardware, specifically advanced semiconductors. The production of these critical chips relies heavily on a singular geographic choke point. The vast majority of the high-end manufacturing required by these tech giants happens on a single island, Taiwan. That places the physical foundation of the U.S. stock market's growth engine just a few dozen miles off the coast of China, a rising, competing global power. A traditional financial portfolio is blind to this reality. It was built for a peaceful world where supply chains function perfectly and borders do not matter. It has no mathematical mechanism to account for the unpredictable geopolitical risk of a closed shipping strait or a territorial dispute. We are entering a period where historical cycles are converging, accelerating change and disorder. To protect your capital, you have to abandon models built for yesterday's peace and adopt a framework designed to endure periods of chaos. This brings us to the core philosophy of Aquavis. If you look closely at geopolitics and the stock market, they behave like natural, complex, adaptive systems. Just like a river flowing through a mountain valley, money and power seek equilibrium and balance. When you study history from first principles, a pattern emerges. The global order is always dictated by the hegemon, the dominant nation, that controls three specific, self-reinforcing spheres of influence. The first sphere is asymmetric technology, the advanced tools that give a nation a distinct advantage. The second sphere is energy. You need abundant, low-cost power to fuel that technological engine. The third and final sphere is money. A dominant power requires a fully controlled, universally recognized store of value to finance its operations and sustain the entire system. Technology, energy, and money. These are the fundamental drivers of power. Empires rise and fall, but these three underlying pillars remain consistent, providing a reliable compass to navigate the world no matter who is currently in charge. Because these pillars represent exactly where the world's dominant powers always focus their attention, this historical framework naturally doubles as a highly effective investment portfolio. In its simplest form, you can build this by holding three highly liquid exchange-traded funds. You take an equal weighted position in a technology fund, an energy fund, and a physical gold fund to represent money. The elegance is in its mechanical simplicity. You let the assets run, and you only adjust when the system gets wildly out of proportion. In fact, over a 21-year period, this exact strategy required a rebalancing trigger only 4 times. This graph illustrates the results of that long-term test. If you invested $1,000 in a standard market index in 2005, it grew to about $7,800. But that same $1,000 placed into the Simple Pillars portfolio grew to over $17,700. By aligning your capital directly with the foundational flows of global power, you stop hiding from market volatility. Instead, you capture it, turning market swings into a compounding mathematical advantage. Those broad index funds are a great starting point, but they sit at the very top of the funnel. The real opportunity comes from tracing that flow of energy all the way down to locate pure, high-leverage investments. Let's trace the technology pillar as an example. Instead of buying a generic tech fund, we follow the macro trend downward and narrow our focus strictly to the semiconductor sector, the physical chips we know the world desperately needs. But we can go even deeper. Within semiconductors, physical scaling is hitting its limits, forcing manufacturers to stack chips vertically. By filtering down to the specific niche of advanced packaging, we isolate a pure, highly targeted expression of the broader macro trend. This exact point at the bottom of the funnel, where multiple long-term trends and historical waves intersect, is what we call the confluence. When you map out these massive, decade-long waves, the daily noise of the stock market fades away. You stop trying to guess tomorrow's headlines and start aligning your investments with undeniable natural economic forces. True financial resilience requires an ordered mind and a strategy grounded in historical reality. When your internal clarity meets a portfolio built on balance, you stop reacting to the world's chaos and you start actively shaping your own future.